Hey everybody, welcome to Masters in Trading Live. My name is Jonathan Rose, and today is our first day of 3 sessions that we're going to be talking about my favorite trading approach. A trading approach that I've used throughout my 27-year career, a trading approach that I've used every single step throughout my career. So guys, Jonathan Rose, I've traded for 27 years. I started trading NASDAQ. When I traded NASDAQ against S&Ps. After that, I traded bonds. I traded bonds for 8 years, but we never traded anything in isolation. Whenever we look for trades, we're always looking at one thing relative to something else. After I traded bonds, I traded on the floor of the Chicago Board Options Exchange. That's where I learned how to value options to the penny, and we were still using some kind of divergence or some kind of pair trading whenever we did those trades. So guys, today is our first day. We are doing 3 sessions on divergences. Divergences, also called pair trading. Some of you might even know it as delta neutral trading. It's not full delta neutral trading, but I'll get into it. We'll explain everything. I got the chat open. Cool announcement. Yesterday, June 31st, we had our biggest audience ever for Masters in Trading Live. So I think word's getting out, or maybe you guys are just sharing the info with your friends. But nevertheless, we got a little bigger audience. So welcome. Thank you guys for joining. This is going to be a heck of a show. Let's go to the slide deck. I got the chat open. We'll keep your questions up throughout the entire presentation. Let's get to it. All right. We're going to be talking about divergence trading. So here we go, guys. We've got 3 days planned. Today, day 1. I want to talk about why every trade I've ever made was some kind of divergence. For 27 years, divergence trading ties down your risk. Michael, did I say June 31st? Yesterday, June 30th. Great catch. Wednesday, we're going to do my 5 favorite divergence tradings, guys. John, thanks. It's going good. Tomorrow, I'm going to share my 5 favorite divergence trades. I'm going to break them all down for you. And then on Thursday, I'm going to leave you with an actionable trade before you go on break. So super excited about that. Today, we'll just go over divergences. Tomorrow, I'm going to give you my 5 favorite divergences. And then Thursday, you guys all going to join on Thursday, right? Because on Thursday, we're going to give you a high conviction divergence trade that's actionable in the market. Awesome. Okay, let's get to it. So let's start here. What is a divergence? Divergence, pair trading, they're synonymous. Synonymous. A divergence happens when 2 assets that usually move together suddenly split apart. These dislocations often signal a high probability reversal or a catch-up move. This is behavioral edge. We are not guessing. Divergences give traders a repeatable structure, and this is how professional traders spot trades that amateurs often miss. So, most important, we react. We don't speculate. We don't guess. We don't cross our fingers and just hope for the market to go higher. Instead, we look at one asset against another asset because we want to tie down that risk. Here's an analogy. I'm going to give you a few different analogies. A presidential motorcade. Presidential motorcade, all moving together. If one car leaves the presidential motorcade, you could probably bet that it's going to be coming back. We can use the analogy of a wolf pack. Wolf pack all moving together. If one of them goes away, we can probably bet on it coming back. They are all staying together. You could also look at a pod of dolphins. Again, the pod of dolphins is all moving together. One might get far away ahead. One might get way in the back. But overall, they are moving together. That's how we want to look at the market. Simplify things as much as we possibly can. That's Chicago. I grew up on the East Coast. I moved to Chicago right when I graduated university. I moved to Chicago because I knew without a doubt that I wanted to trade. That's me. This is the floor. This is the NASDAQ pit. And this is the NASDAQ on computers. The trade, we would trade this against this. Boom. We weren't just betting on whether the NASDAQ is going to go way up or way down. We were betting on the relative relationship. We would also bet on the relative relationship between the NASDAQ cash and the NASDAQ futures. We would also bet on the NASDAQ futures versus the S&P futures. Again, everything is a divergence. Nothing is crossing our fingers and making a binary bet on something going higher or going lower. The trade worked. That divergence became the foundation for how I've traded ever since. So this is from 98 to 03. After that, this was my matrix moment. This allowed me to see the market differently. And because when I was on the floor, there were still people who were down on the floor who were trading the NASDAQ or trading the S&P, and they were using technical analysis and trying to predict where the market would go. Those guys never survived. This was my matrix moment because it was here that I realized the most important thing that traders need, and traders need edge. When we talk about a trader's edge, what does that person do differently that gives him odds of success? Just betting on the NASDAQ going higher or lower in a week's time, you may be right this week, but over the long term, you're not going to be successful. We can't predict or guess where the market's going to go. We have to nail down the market and find our edge, find a reason for why we should be in that trade. After NASDAQ, I went to go trade bonds, then I went to go trade options. This is when I really started following divergences, and I believe once you see it, you can't unsee it. Right here, there's 3 products on my chart. These 3 products, or 3 stocks I'm looking at, ZIM, GSL, and DAC. It's not important what these tickers do, what these companies do. What is important is that these are all marine shipping companies. Marine shipping companies, going back to 2023, Mr. Penn, where'd you go? Going back to 2023, you'll notice they move together, right? The white one's a little bit more volatile, but overall they move together. Somebody looking at things for a divergence may look at this, and when the white gets inexpensive, maybe they'll buy that. Maybe they'll sell that and buy one of these. Maybe they'll sell that and buy one of these. What we don't do is just bet on that white line going down. There's no edge. So again, these 3 stocks are in the exact same sector. That's why you can look at them as a divergence. Here you go. These are all trucking companies. The sector is moving together. Go back to 2023. These 4 stocks, if you would have hold, they're going to be at the exact same place, right? You get in, they go to the exact same place. But look at the journey they take to get there, because that's where there's edge. Notice the big disconnects, guys, between the green line and the yellow line. Overall, these companies are in the shipping industry, the trucking industry. So over time, they are going to move together. What's really important is to get long what's inexpensive and to get short what's expensive. But it's a much simpler way of looking at the market than just making binary bets. And again, this is something I've done throughout my entire career. Every single step throughout my trading career where I've made millions has used divergences. The next trade that I do, whenever, it's going to use some kind of divergence, because nothing is ever just inexpensive in isolation. Nothing's expensive in isolation. You need to look relative to something else. Here's another one. Some more shipping companies. But again, look at them, take a step back, and look at them as one line. And then when you look at them as one line, you may consider to sell the expensive one and buy the inexpensive one. How has that trade worked out in the past? Well, really, really, really good. And again, guys, throughout my entire career, I've always used some kind of divergence. So what I want to do now is I want to go through a case study. Here's a case study of a closed trade that we have. I can only share our closed trades with you because if I share open trades with you, it might be seen as trying to influence the stock, and we certainly are not going to do that. Let me take a sip of my water. Let me just get a show of hands. Are we doing good? Let me get a Y. Does anybody have any questions? Does this make sense? Let's just check in with all you guys. Let me get a Y if this makes sense. Yes. Or N if it doesn't. And please feel free to ask any questions that you have. As those are coming in, I get to share my great news that yesterday, June 30th, Mike, thanks for, I first said June 31st. There is no June 31st. We had our largest audience ever for Masters in Trading Live. So I thank you. I welcome all new users. Getting a lot of yeses. Let me know if you have any questions. Let's go through an example. Because here's an example of a trade that was closed. We did this trade right before Liberation Day. Love to hear a glockenspiel. Thanks, Rick. So we did this trade right before Liberation Day. I kind of think this is a common sense trade. The trade that we did before Liberation Day was Trump came out with massive, massive tariffs. The trade was Mexico versus Brazil. And Brazil, just being in the business for a long time and being an active trader, Brazil is controlled by China. Now, in the markets, Brazil's controlled by China because of agricultural products. That's why it just is. So China controls Brazil. So the thought was, after this Liberation Day, let's look at the relationship between Mexico and Brazil, nicely, tightly correlated. But I also know that Brazil is heavily influenced by China. Again, we are not guessing direction, guys. We are guessing the relative difference of the two. And here we have EWW is white, Mexico, and EWZ is blue, Brazil. So the trade was literally right here. Going into Liberation Day, which was 4:02, right? We played for Brazil getting its butt whooped. Why was I going to get its butt whooped? Because of China. And also at the same time getting long Mexico. you'll see what happened. They both got crushed right after Liberation Day, right? But then as time passed, they both recovered. How did we do the trade? Here's the exact trade. The trade is closed, so we can share this trade. The full risk was $270. $270 of risk. We did two trades, one trade for $88 and one trade for $182. Well, right after tariffs were announced, April 2nd, April 4th, Brazil got absolutely demolished. So we were able to close that trade. But at the same time we closed that trade, we did not touch Mexico. Brazil got crushed. Then we waited 17 more days until Mexico rallied, and we're able to take off 117% on one trade, 84% on the other trade, for a full 100% return. Because again, guys, when you see a chart like this, and if I don't even tell you what they are, and if I just say, hey, let's just wait until these break apart because they should come together, seems like a pretty sensible trade. So many times people are trading and they feel like they're gambling and they feel like they have to get lucky. But instead, these don't present all the time. There is nothing to do here, nothing to do here, nothing to do here. Again, the trade presented. When traders talk about discipline, this is the discipline they're talking about. To stay out of the trade when nothing is happening. Also, what always is going to help with your discipline is finding a mentor and finding a community that you can ask questions of others that are doing the exact same thing. So very, very cool. Awesome, awesome trade. All right, last couple of slides. Why is this the foundation? Forget direction. I want you to think that you're not good at picking direction. When people say they're good at speculating and they're good at technical analysis and they're really good at picking direction, that's a red flag because that's going to give you a false sense of confidence. Education mitigates risk. The more you understand these relationships, the less you rely on hope. Divergences aren't hype. They're how real traders survive volatility. No guessing, no gambling. We just want to exploit these dislocations. Okay? These are two rules that guide everything that we do. Not gambling. This is structure. This is edge. So two rules guide really kind of govern what we do. We want to react. We don't want to speculate. I can't say this enough. We want to react. If Mexico is super, super strong and Brazil's not, that might be a trade idea. React, don't speculate. And then finally, you have to keep learning. You don't need to be perfect, just informed. We're going to do 3 days of classes, guys. Tomorrow, I'm going to walk you through my 5 favorite divergence setups. We also have an awesome announcement that we're releasing. This is the very first day this is being released. You can go to masterthantrading.com/Divergence Trader 2025. We have a brand new, I think this is 1 hour long, but we had a divergence trade where one of our traders turned $44,000 from one trade into $180,000 doing a divergence trade just like I'm teaching you right now. So I encourage you guys, go over to masterthantrading.com/Divergence Trader 2025. Also, this was day 1 of 3 days where I walk you through how and why we trade divergences. In tomorrow's presentation, I'm going to share with you my top 5 divergences. Many of these I've been following for over 15 years. Guys, thank you so much for joining. Hope you guys enjoyed this, Everybody in our paid all access, we're going to hop off right now and go over some of our active portfolio. Thank you guys all for watching. We'll see you guys tomorrow.